every single day throughout our calls. If there's any newcomers or if you have any questions you absolutely came here wanting to get answered, please use the chat box. All right, we have at your screen, you should see chat at the bottom of the screen, and you should see a Q&A box. Feel free to use both. I have Sarah Shellham with me that she'll be monitoring the Q&A and chat box just in case I don't see it. And Sarah, if there's any questions you think would be important to kind of announce out loud, feel free to interrupt me anytime you want. So guys, again, my name is Juan Deshon. I'm one of the IRA specialists here. I know the class was supposed to be with Derek Long. He's an IRA specialist as well. Him and I work closely together. Been working together with him for almost 5 years now. So no worries, guys. You're in good hands. We're going to go over everything you need to know. But again, as I mentioned, if you need anything, put it in the chat box. If it's your first time here, please let us know how you heard about us and also where you're from. So I'd love to know, where we're getting everyone here from. So I'm going to go ahead and start sharing my screen as you guys join on. And we're going to get right to it. All right. And so I got my chat box open, so feel free to throw any questions in. And Sarah, just give me you're good in the chat box if you guys see the correct screen.
We're good.
All right, awesome. Thanks, Sarah. So guys, as I mentioned, we're going to be going over Roth conversions today. I'm going to go over everything in regards to the Roth IRA, important information, why you should consider a Roth conversion, how it looks, how it's done, what are the implications, all that good stuff, how you qualify, etc. So let's get right into that. Before we get started, though, again, big disclaimer, I'm not a CPA, advisor, tax attorney, nothing, right? My specialty is in IRAs. I have CISP, or you'll see that a few of us have that here at Quest, which just means Certified IRA Service Professional. It means that we've proven that we know a lot about IRA accounts, but again, make sure to consult with your professionals to make sure that what you're about to do in regards to your retirement and accounts, you have the proper advice, it's right for you. Everyone's situation is different, but I'm just here to kind of arm you guys with the right tools to make the right decision. For our newcomers, what is a self-directed IRA? We're going to fly through any of the information that's fairly new, fairly basic, because we do have a basics class. And so if you haven't seen that, stay on today. You're going to learn some, but if you need a refresher, please check out our one-on-one class. And so Robert, I hear you have some questions there. Feel free to throw some questions in the chat box. We'll answer them as we go on, or Sarah will do so as well. So again, for my beginners, what is a self-directed IRA? What do we do here at Quest? Well, a self-directed IRA, the term self-directed is made up, right? That's a completely marketing term. An IRA at Quest and an IRA at Fidelity are exactly the same. Now, there's multiple types of IRA accounts out there, and we're going to go over that briefly. But just understand that an IRA's rules don't change whether it's self-directed or not, right? Self-direction is used just to make sure that you understand that you can use these accounts for private investments, such as notes, real estate, private entities, right? That's the most common things that we see here, but that doesn't stop there. So what are those different types of accounts that you see here? These right here. So these are the 7 different types of accounts that at Quest we administrate and we can hold. Now, these accounts you will also see at other places. Charles Schwab, Fidelity, you'll see most of these accounts over there as well. Merrill Lynch, Wells Fargo, right? Because again, they're all the same. These IRA accounts are legal entities and they don't change. They all abide by the same publication and same IRS guidelines. But when you move them to Quest, they become self-directed or any other self-directed custodian to use them towards private assets. We group them into 3 different categories, and that's the best way to kind of think about them. The most common being the personal plans. The personal plans are traditional and Roth IRAs. So we're going to be going over a lot about the Roth IRA, so I'm not going to touch that right now. But the traditional IRA is probably the most common account I see out there. And the reason being is because I call this the pre-tax bucket of money. Most of America's wealth actually is in retirement accounts. And those retirement accounts is money that has not been taxed yet. Now, when it hasn't been taxed yet, I consider that pre-tax, and the way it grows is it's tax deferred, meaning it's moving the taxation just further and further away from you. And until you decide to finally touch that money, that's when you pay taxes. So when an individual comes from an old job and they tell me, hey, Juan, I have a 401k account or some sort of employer plan, there's various types. I want to move that to an IRA, but I don't want to pay taxes or penalty. Well, then they usually move it over to a traditional IRA. It's a seamless movement and there's no taxes, no penalty because you're keeping that money pre-tax. And then now you have the ability to kind of invest in what you'd like to. That can be self-directed, or that can be, again, as I mentioned, that can be stocks and bonds if you wanted to with Fidelity, for example. Now, for people on here that might be self-employed, these plans might be work for you, the employer plans, SEP, Simple, and 401k. Now, we do have classes on these employer plans, but I'll briefly go over these guys. The SEP plan is probably the most common self-employment plan because it's very straightforward. It's very common. This one's very common for example, realtors, individuals who work for themselves, file Schedule C or 1099 income, and want to provide themselves with some sort of nest egg for retirement. A SEP plan gives them the ability to put in a pretty nice chunk of change in that account, up to $58,000. It really depends on their income. That's when I would say consult with their CPA to see how much of that you would qualify for, but ideally, it'd be a pretty good chunk. Now, a SEP IRA, it allows you to do that and then invest it however you please, but it is a pre-tax bucket of money. It'll give you or your business a deduction. So the money will grow tax deferred, similar to 401ks and traditional IRAs. The second one, Simple IRA, a little bit less common that we see in the self-directed world, but was very common for normal brokerage type of accounts. And the reason being is because it's a way for individuals who have small businesses with employees, specifically less than 100, to set up a kind of, I call it, mini 401k plan. The employee can put money in up to $13,500 or $16,500, depending on their age. And also the employer can incentivize them by matching between 2 to 3%. So that is why I call it a mini 401k, very similar to the structure we know in corporate America of 401ks, but just a little bit smaller the numbers. And it comes with a lot. It's very cost effective. I would say it's a lot cheaper than a 401k is for the employer to have Simple IRAs than it would to maintain a 401k plan for their business. That's why we see those very popular in, for example, dentist practices, small practices like that with very minimal employees, mom and pop shops, things like that. And then the 401k plan, that's the big kahuna here, right? It's the biggest account here. It allows for employers to participate, but specifically the one that we have here at Quest is called a solo 401k, or sometimes referred to as a QRP. This plan allows for self-employed individuals with no employees to basically copycat that 401k that they've had in the past with employers. Allows for large contributions, allows for complete control, allows for loans to themselves. So it comes with a lot of bells and whistles, but with that comes a responsibility and is a little bit more of a costly plan than the IRAs are. So if you're interested in any of those, just shoot us a message at the end of this webinar. We're happy to walk it through with you guys. Again, we also have classes. I saw Sarah put our videos up on the chat box. If you go there, it takes you to a page and you can see a bunch of pre-recorded classes on different topics. One of them is employer plans. And then lastly, we have our special plans. And this is the Coverdell ESA, or stands for Education Savings Account, or the HSA, stands for Health Savings Account. These plans are the only ones that you can use today and potentially have tax-free benefits. So to start off, we have the Coverdell ESA, and this plan is an account that you can set up for a child under the age of 18 and start funding it from the day they have a social, basically. Put $2,000 into the plan. You can invest it just the same way you would invest any of these other accounts. And with that growth, you can withdraw that money to pay for qualified education expenses. What are qualified education expenses? There's a wide variety of them, but they cover not just college and tuition there, but they cover things from elementary school up, right? Books, uniform, of course, tuition. You can pay for Wi-Fi, laptops, because in this day and age, you need a laptop to do your homework these days. That's definitely in middle school and high school and definitely college. Right. So it pays for a lot of educational expenses, but for the most part, I see people use it for tuition. The idea behind it is start them young, put $2,000 in as they're very, very young, until they grow 18. And at the same time, you're investing it, right? Let compound interest do its work. Hopefully you created a nice little nest egg to take that money out without taxation to pay for any of those education expenses. In the HSA is kind of very similar. However, it's for health purposes. I love this plan. I use it myself personally all the time. The HSA plan is one that you can invest, again, just like any of the other accounts, but we call it here the best of both worlds because it does something none of these accounts do. It gives you a tax deduction when you put money into the plan, but also gives you a tax-free withdrawal or distribution when you take money out for qualified health expenses. So the IRS is saying, if you put money in here, we're going to deduct it from your taxes or from your, I guess, your income to lower your taxes. And then we're also going to allow you to take the money out, even that same dollar amount that you just used for deduction, you can take it out tax-free as long as for a medical expense. Now, for the most part, the rule of thumb is as long as it's for your health, then you can use it. Now, there's definitely, some caveats to that, but you can check out the publication or just email us and we'll send you the publication. But ultimately, for example, I've used it for going to the chiropractor. I've used it to buy the glasses I'm wearing in front of you today. I've used it to pay for the eye doctor, for the dentist, right? So these things are for my health and they do qualify as expenses. I can use my HSA. On top of that, I can also invest it. And the idea behind it is not only just using the funds that I've put in there for deductions, but also use the funds that I put in there to invest and I've grown. And as I'm using the profit, now I'm using tax-free money. I just came from profit and investments now to pay for my medical expenses. And the thing is, with any of these 7 different accounts, you don't have to stop at just one. Many of our clients here have traditional Roth IRAs, HSAs, and ESAs, right? And maybe they even throw in an employer plan if they're self-employed. So you can use multiple accounts to basically beef up that nest egg of retirement and use them together for one deal. Now, I'll answer this question here that Stacy put in because it's in regards to the HSA. The question here, if you guys don't see in the chat box, is what happens to your HSA as far as contributions if you leave current employer? Can you contribute any more if it is established? I know you have to have a high deductible insurance. So thanks, Stacy. That's a great point. So you do have to qualify for an HSA plan. You have to have high deductible health plan. If you don't know if you do have one, just double check with your insurance. Now, if you had one because of an employer and you left that employer, you no longer have that insurance, the HSA does not go away. However, your eligibility to contribute does until you recontinue with another plan that would qualify for the HSA plan. So this money never goes away. If you have it in there, it's still there and you can still use it for medical expenses. But what the IRS doesn't allow you to do if you are no longer qualified, which is having that high deductible health plan, is you can no longer continue to contribute that year. And for the individuals here that want to know, the contribution limits for the year 2021 for an individual without dependents is $3,600, and for someone that does have dependents, it's double that, right? So you do get a good chunk, and you maybe even get $1,000 extra if you're over the age of 55. On our website, we have the exact contribution limits if you guys want to take a look. But great question, Stacy. Thank you for that. So as I mentioned, all of these accounts can be used together. They can be used in a deal together, but how does that work? How does that look like? And every deal, there's a contract, some sort of agreement between the IRA or IRAs and investment. And so there has to be a name, right? If I myself, Juan Deshon, am making an investment personally, Juan Deshon is going to show up on that contract. But if I'm doing it within my IRA account, my IRA's name's got to show up on that contract. Now, there's different ways this can show up. If I only use one of my IRAs, well, then simply it's going to be Quest Trust Company, FBO, Juan Deshon, or in here, in this case, John Smith, IRA 12345, right? My number. That's the legal name for the IRA. And if I'm going to use multiple accounts, let's say, for example, I use my Roth and my traditional IRA because I have two. Well, then what happens is now there's an undivided interest. Now here in the partner investing, you can see that we've put it as a 50-50 split, but this could be any kind of split you want, 75-25 or whatever it is. It can go down to the decimal point. But it just reads as following: Quest Trust Company, FBO, John Smith, IRA 12345, and then in parentheses, as to an undivided 50% interest, and then lists off the second person. I've seen a note out there with between 9 to 12 different IRA accounts. And yeah, the lender's name turns out to be pretty lengthy because it has to list out every single person and their interest. However, it's done. It's doable. And the borrower only receives the money from one single place. So it's very easy. Zena says I'm very low. Sarah, can you confirm that? Can you hear me all right?
That's okay on my end. Maybe
Okay.
speak a little bit.
Okay, I'll try. Yeah, I have the mic. I'll put the mic a little closer to me right now. So hopefully you guys can hear me. I have a little mic right in front of me that you can't see, but I put it closer to me. Hopefully that helps. So with the IRAs, the next point, I want to go over the restrictions on IRAs, right? Before we get into the Roth conversions. Understanding what you cannot do is a vital thing, especially about self-directed IRAs, because we come into that a lot. When you're with a traditional route like Fidelity, whomever it is, you don't have to worry about this too much, right? Unless you're Elon Musk, you don't have to worry about investing into Tesla, and is that going to be prohibited to me? But when you're doing private transactions, you want to know the rules. Thanks, guys, for confirming I'm sounding good. So the first thing we want to go over is people restrictions. So who are disqualified to your IRA? When I say that, that means that people cannot benefit indirectly or directly from your IRA. So who is that? Primarily, it's you, right? So here we have an illustration of myself and my IRA on each side of the fence. Essentially, what you don't want is you won't want transaction to go from one place to another, right? You don't want your IRA loaning you funds. You don't want your IRA buying a home, for example, and then you living in it. You're benefiting from that, right? You don't want your IRA funding into your startup company or your LLC, whatever it may be, because that's a personal benefit. And the IRS really does not want you to benefit from this money unless you pay taxes, right? So that's the whole idea behind these rules. But they also list off a few other people. And these people are right here. Now, you don't have to memorize this. You can take a picture if you want, but you don't have to memorize it at all. Quest is always here to make sure you're never doing one of these prohibited transactions. But to make it very easy on you, the people that are on this list are yourself, spouses, children, parents, and the spouses of your children. It stops right there. And the reason why is because the IRS sees that this is the way that wealth is passed. So they automatically disqualify these individuals and consider them fiduciaries to the account, and you can no longer invest with them directly or indirectly. It also goes off, and this is on the right side of the column, it goes off to say that their corporations, their partnerships, their trusts, their estates, their LLCs, et cetera, those are also disqualified. Now, there's some caveats to them and whether or not they're disqualified, depending on the involvement of that individual. But for the most part, if you have an individual that is your son and he has a company and it's his company and he's looking for capital, unfortunately, you cannot use your retirement funds to help your son out. Robert, I just want to address that real quick. The final discussion about the bill. We will be touching on that bill later, and Sarah will be sending over that YouTube link at the end of this webinar. So no worries. Now, I mentioned you can't buy, sell, trade, loan, or extended services to these IRA accounts. That's really the kind of gist of it. That's all you really need to know in regards to prohibited transactions. For the most part, you don't have to become an expert. Just understand that if you're trying to do these deals, call Quest. We'll make sure they're not doing anything prohibited. So let's get into the meat of it. I flew by that, took a little bit, but I flew by it because I really want to get into what you guys came here to watch. So let's go over the two types of money, starting off about the Roth conversion. So as I mentioned a little bit before, the traditional IRA is a bucket of money that's tax deferred. And that means that basically it's just moving taxes later and later until you distribute or withdraw the funds for personal use, and that's when you pay them taxes. The Roth IRA is a little bit different. The Roth IRA allows you to put after-tax dollars in it. So every 2 weeks when I get paid by Quest and I get my check, they've taken taxes out of that and that goes to my checking account. From there, I can decide if I want to contribute to my Roth IRA. So I'm contributing, if I do, money that's already been taxed. So let's say I put my maximum, which is $6,000 in a Roth IRA per year under the age of 50. At that point on, what the IRS says is if I keep that money in there and I continue to invest that $6,000 within the Roth IRA, and I keep it in there until I'm 59 and a half, all the investments and further contributions I'm going to be making are growing tax-free. So after the age of 59 and a half, contingent, I've met two qualifications, the age requirement, as well as having the Roth for more than 5 years. Anything I have in there is completely tax-free to me. So opposed to the traditional that I pay taxes at the end, the Roth IRA, I wouldn't because I pay taxes at the beginning. So which one's more useful to an investor? I'll let you decide. Everyone's situation is different, right? If you're an individual with millions of dollars in pre-tax money, it might be difficult for you to kind of just move that over to a Roth IRA, and we'll talk about that why. But for the most part, that's why every guru out there talks about you should have a Roth IRA. If you have children, starting them with a Roth IRA young is ideal, right? There's also other benefits in the Roth IRA, like, for example, being able to take up to $10,000 tax-free for the purchase of the first home, right? That's pretty nice. There's some other things out there that the Roth IRA helps you out with, but I have seen parents setting up Roth IRAs for their children, and it helps them in the long run. It helps them start early. The only thing you need to qualify for a contribution to a Roth IRA is earned income. So what are the details of it? I know a lot of people here might say, well, I make too much money, or do I make too much money to contribute? I hear there's limitations, and there are, right? So the contribution limit for 2021 is $6,000 and $7,000 if you're over the age of 50. That's that catch-up contribution. Now, you are subject to limitations, right? So we'll look at the limitations here on this right side right there. So single, if you're filing single, your phase out ranges, I'll explain what that means, but your phase out ranges is between $122,000 and $137,000. So for example, if I'm an individual making $129,000, which is just roughly half of that right there, that means 50%, I qualify for 50% of a contribution because I'm right there in the middle of what the phase out range is. If I'm over $137,000, well, then I don't qualify for anything with the contribution. But so just put an example, if I'm $129,000, I know that I'm 50%, halfway there. That means that I can contribute $3,000. I'm below the age of 50. If I'm over, then that'd be 3,500, right? So that's kind of how you want to work that out. If you're married filing jointly, well, it's $193,000 to $203,000, and that's your phase out range. So if you're an individual watching here, you can kind of take a look. Am I qualified to contribute to a Roth IRA directly, meaning putting money from your personal back pocket into that Roth IRA? Now, there's one thing here that isn't mentioned because it doesn't really qualify for most people. But if your individual is married, filing separately, the IRS does penalize you a little bit. They make the phase out range a lot smaller because the phase out range is between $0 and $10,000. So if you're married filing separately, they kind of penalize you and make that income limit very low. This is going to be your AGI. Great question, Susan. This is your modified adjusted gross income. Now, if you make over this amount, if your AGI is over this amount, it doesn't stop there. That's kind of our topic of today, the conversion, right? So conversions didn't go away, right? There was some questioning sometime in 2010 when a rule came out that was stopping recharacterizations, but it does not stop Roth conversions. Roth conversions, there's no limit. As far as no matter how much income you make, you can always do a Roth conversion, which is simply putting money from one account to another, moving money from a pre-tax bucket of money to an after-tax bucket of money, right? And at that point, you pay taxes. And we'll discuss a little bit how that works, but why would someone want to do that? So this is a little slide about benefits for Roth IRAs. I kind of went over this stuff a little bit, but let's just go over it one more time. Prior year contributions can be funded until tax filing deadline plus, right? So right now you had until, I think this year, the tax filing deadline went until June 15, I think. But in normal scenarios, it's April 15th. And so you have until April 15th to contribute for 2021 still for a Roth IRA. And you could set up a Roth IRA April 14th if you wanted to, and then contribute that same day as well to contribute for 2021, and then move on and then contribute for 2022 later on. So just make sure, just understanding that you have time to contribute to a Roth IRA, but you definitely want to start that as soon as possible. One more thing I will mention on the contributions is when you make your first contribution, that's when your clock starts. So I mentioned earlier the qualifications for tax-free distributions. That's 59.5 and having the Roth IRA for 5 years minimum. That clock starts in the tax year that you make a contribution. So if I made my first Roth contribution ever in the year 2021 or today, then my clock starts at 2021, right? So 2026 would be when I meet my 5-year minimum. Qualified distributions from Roth IRA are tax-free. Qualified being you meet those testing rules. Non-working spouses who are married filing jointly can also contribute to a Roth IRA. So for example, my parents' situation is my mother does not work, my father does. However, if my father wants to open a Roth IRA, he has their earned income to do so. They file it jointly, so does my mother. As long as he makes more than $12,000 in AGI to compensate for both of their contribution limits, then they're in the clear. All right. So even if one of you don't have income, you can still contribute. However, if you're setting up for your children do definitely need earned income. Maybe they have their own job. I've seen people set up very young children, ages 1 to 2, with Roth IRAs with earned income in very savvy ways. In that situation, I'll leave you to talk to your CPA, see how you can work that out. If you're self-employed, you might have a way. And then the last one is no required minimum distributions. This is a RMD for short. When you turn age 72, the IRS requires you to take money out based off of your age. They give you a divisor in this whole little math equation that you do, that you take the total value of your account, and then you take your divisor that they give you, and you find out what's your required minimum distribution out of a traditional IRA. So they force you to take money out because they're saying, hey, you're getting old. We want you to pay taxes. All right. And the last one is tax-free income for your heirs. So someone who inherits a Roth IRA, will have tax-free income. Now, the way the rules are now is if you're let's say a child inheriting an IRA, different rules for different people, but for children, for example, you can have that Roth IRA for the next 10 years if they're over the age of 18. And by that 10th year, they have to distribute everything. But in the meantime, they can use it how they want. They can continue to invest it. They can use it for periodic distributions, but everything they take out of it is going to be it's going to be tax-free anyways, right? If they're a younger child below the age of 18, that 10-year clock doesn't start until they turn 18. Yes, Susan. So the way the children work is not RMDs. The old rule used to be RMDs based off of life, but they changed it now. They kind of simplified it, made it a little easier. And now basically it's just they have 10 years to deplete the account. That's a new rule now. If you're a spouse inheriting an IRA, you have different options. But for children, they do have 10 years to deplete the account after the age of 18. All right, so conversions. Let's look at a conversion regular situation. Why this average Joe might want to consider a Roth conversion. So he's been employed at a factory and he's worked there for 20 years. He's built up a decent retirement, but he's not a real estate investor. So what are his options? He has a 401k plan with all pre-tax funds, but he understands that if I invest that money, I'm going to pay taxes eventually. I'm going to pay taxes on whatever I grow it to. So he decides, I want to do a Roth conversion. What happens here? It adds to your modified adjusted gross income. So let's say, for example, average Joe here makes $100,000 a year, and that puts him around the 23% tax rate. What happens is if he does a conversion of, let's just put $50,000, that $50,000 would be taxed at his marginal tax rate that he sits on. Now, if that bumps him up a tax rate, which I don't think it does, but just going off memory, but if it did, then that means that he would pay some of it on a larger tax rate, right? Because we have marginal tax rates. So that's how you can kind of calculate very quickly what would be your tax liability. How much are you going to pay in taxes? Well, how much do you make? What is your tax rate? And that's kind of right there. Again, could cause them higher tax rate with lower returns, because average Joe is just going to go ahead and throw that in the market. With lower returns, it could take a long time, depending on how much he converted, to make up that cost. All right. Now, we're not average, right? Real estate investors have very savvy ways to work the tax law, right? When you make real estate investments, you get incentives, you get benefits, you get deductions, right? You get expenses, you get the write-off, right? You get a lot of things here that might lower that AGI, might put you at a lower tax rate. So it might be good for you to do Roth conversion because you have things that can offset that cost, right? If you do the calculation, you can see it. If it's a CPA, you can see how much it's going to cost you. You can see what you have going on as a real estate investor, what kind of deductions you can expect, and you can see if you can mitigate that, right? So what are some conversion things and how you can think about it? Well, everyone's different, but let's look at a real example. And we're going to also look at in a few slides, we're going to see what exactly we want to think of when we do Roth conversions. But real example here. So let's take normal person here, has a traditional IRA, age 52. What his plan is he's going to make it to $1 million, right? He's doing some pretty hardcore investments. He's going to grow that $100,000 to $1 million by age 72. At age 72, he's going to have to take RMDs, those required minimum distributions. Let's just say, for math purposes, that he's being taxed at a 20% tax rate because of his income or whatever he has going on. That means that he would pay $200,000 in taxes when he starts, if he took out that $1 million to just retire on, right? Of course, he might not do that all at once, but just for easy math purposes. Now, what if he did the opposite? What if prior to investing that $100,000, he did the conversion? Now, he's going to have to bite the bullet a little bit. He's going to be taxed at 40%. It's going to put him at a high tax rate, but he pays $40,000 in taxes over the span of that $100,000. So as he invests it, there's no RMDs at age 72. There's no taxes. So what he receives is 100%, $1 million or $900,000 completely tax-free. He only paid taxes on the $100,000. So when we look at the situation, paying taxes on the acorn rather than the tree makes a lot of sense out of these extremities, right? Now, everyone's situation is different, as I mentioned. So you want to double check, consult. You want to look at, you want to consider different things. So what do you got to consider? Generally, what are your tax rate you on? Right? What do you think you're going to be in the future? I know individuals that in the future, they make more money than they do now. Or I know individuals that in the future, they make less money, or they show that they make less money than they do now. So what is your situation? What is your goal? What are you going to be like in 10, 15, 20 years, or when you want to retire? right? Can you afford to pay taxes from funds outside of your IRA? That's the biggest question too, right? If you're in a situation where unfortunately you want to make the conversion because it'd be a good idea, but you're going to be hit with a tax bill come April 15th that you can't pay, probably don't want to get yourself in that situation, right? So that's why it's kind of convenient to talk to your CPA, see what situation you're in. Everyone's different, but if you can do it, it might make sense to pay off the acorn out the tree. Would it bump you up a tax rate? Right? What would it do to your income situation if you did a conversion? It gets added as earned income. So just consider that. And what is your goal for your heirs? Right? If you're looking at estate planning and making sure all that's buttoned up, who's going to be inheriting your IRA? Is your IRA $1 million? And are you going to leave it to your children? And are they going to pay the taxes? Are you going to leave it a traditional IRA? Or do you want to convert it, bite the bullet, and leave them tax-free growth? Right? I guess it depends on how much you like your children. And what are your projected gains on your investment? This is the biggest key here to analyze a Roth conversion. I mean, what are you going to grow that Roth IRA to? Are you going to simply just get a steady 6%, 6 to 8% every year? Or are you going to be going, hard on the Roth IRA to grow that account exponentially? Are you going to be using savvy things like buying real estate, what's going to appreciate, has rental income? Are you going to do options? Are you going to be flipping contracts? Are you going to be loaning funds to real estate investors that are going to guarantee you 12, 13% interest? What are you going to be doing to gain money inside of your Roth IRA? Does it make sense enough to now make that Roth conversion because you have a pretty good Roth? I had take a little break here to show you an example of how I had that happen to someone. A client of ours, about 10 or so years, bought a house, actually a townhome in the Heights here in Houston. If you're here in Houston, you know where that area is. It's kind of booming right now. A lot of townhomes there. The real estate is very expensive. I mean, I don't think you find a townhome less than $400,000 now, maybe even more now. So what happened was they bought a townhome and they bought it for about $300,000 back in the day. A very large townhome, 3-story, pretty solid square footage, in a great location right off one of the main streets. They came into Quest and they were getting older and they wanted to like find out what they can do with that property. I think they wanted to almost distribute it to themselves because they wanted to live in it. So we kind of went over the situation and they were looking to distribute to themselves. So they actually ended up having to get an appraisal of the property and find out what it's all worth and what the tax liability is going to end up being, et cetera. Come to find out that house was now worth over $1 million, right? They had it in a traditional IRA account. So now they're going to pay taxes on $1 million distribution because of what the house is worth when they could have paid taxes on $300,000 prior. Now that, of course, it makes sense why they probably didn't want to pay tax on 300 grand, but it was just funny to see, I shouldn't say funny, but it was interesting to see the way his wife looked at him as soon as I said that, because she was like, why didn't we do that? Right? Because now they're going to have a higher tax bill. So some things you want to consider. What are your investments? What are they going to be like in the future? Calculating your recovery period is also a big thing. So this is in a situation where if you know your tax liability is going to cost you $30,000, just to put a number out there, how long will it take you to reach $30,000 tax-free gains in your Roth IRA? Is it going to take you a year? It's going to take you 2 years, 3 years, right? And see if that makes it worth it, right? If you're going to retire in 20, 30 years and it's going to take you 5 years to recover that money, I think that's a pretty good recovery period, because then you have more years after that to continue to grow that Roth IRA. So again, it's all a consideration of your current situation, talking to your CPAs, finding out what you're going to be doing with that Roth IRA is going to determine whether or not you should move forward with that Roth conversion. And the biggest thing I'll mention, in all these situations, we're talking about doing a conversion of the total amount. You don't have to convert the entire amount. All right. You can convert partial amounts. It's okay. You can do it in multiple years. You don't have to do it all at once. I've had clients do that as well. They spread out their conversions within the next 10 years. They're doing little bit by little. And so there is possibility to do that as well. Now, I get the question a lot that, do I make too much money to make a Roth conversion? I kind of hit that later on, earlier on, but no, you don't, because there is no income limit for Roth conversions, right? They lifted that So there's no reason that you shouldn't do a Roth conversion, even if you're a millionaire, other than maybe it's going to cost you a lot. But don't let anyone tell you that if you make too much, you cannot do a Roth conversion. That's getting confused with the concept that if you make too much, you cannot contribute to the Roth IRA. But a conversion is not a contribution. All right. So I hope I got the wheels turning a little bit. Anyone could turn a traditional IRA into a Roth IRA, right? You can always at any point in time do it. Now, I want to touch on a little bit of what happens in situations where you do make too much money to contribute to a Roth IRA, but you really want one, because we have to do what's called a backdoor Roth or a conversion. And ultimately, what I'm doing here is a traditional IRA has no income limits for contributions. You can always put money in there. So we have what's called non-deductible contributions, meaning you're an individual putting money in a traditional IRA, but you're not doing it for the deduction. So you have to report it and say, hey, this is non-deductible, to tell the IRS that on a form 8606. You got to tell them this and say, hey, this is non-deductible. I'm putting $6,000 into my traditional IRA. And then what do you do next? Well, the next step is to do that conversion of that same $6,000. Theoretically, because that $6,000 was classified as non-deductible, meaning it's after-tax money sitting in a tax-deferred bucket of money, that $6,000 when made into a conversion should not be taxable. They should look at how much you converted. They should look at how much you have in non-deductible contributions, and it shouldn't be taxable. Right. So that method right there is called the backdoor Roth method. It's how individuals with high income earners can still have a Roth IRA and contribute to it. And you can do this year over year. Robert, can you convert a 401k Roth to a self-directed QRP Roth? Yes. So for your question, if you have a current Roth IRA or Roth component to your 401k at your employer, and you set up a self-directed solo 401k like the one I talked about a little bit earlier, you can do what's called a rollover between the two. You just move funds from one to the other. Great question. Now, what you cannot do, though, is if you're an individual with a Roth IRA, and then you want to have a solo or a QRP 401k, you cannot move Roth IRA to solo 401k. They're actually treated a little bit differently. Interestingly enough, just extra information, a 401k that has Roth money will have RMDs. A Roth IRA will not. So you can't do Roth IRA to 401k, but you can do 401k to Roth IRA. So just a little more information there for you, Robert. So as I mentioned a little bit before, kind of teased it a little bit. What if I do a little bit of conversions? I can do partials, and you can also convert assets, right? Not just cash. So if you have a property like the couple I talked about that has a townhome in the Heights, right, in their IRA account, they could have converted that property at any point in time as well. What you end up doing is you get an appraised value of that property. Let's say it appraises for $300,000. Well, then the IRS would consider that as if it was cash. They would just tax you on $300,000. Your 1099-R would report $300,000 taxable income to you. And then that asset would be deeded over to the Roth IRA under the Roth IRA's name. And then moving forward, anything that asset generates income-wise would be tax-free. All right. So it all comes down again to the acorn of the tree. Susan, there's a quick question here. Doesn't the clock for 5 years on a conversion start when the conversion occurs rather than a time was open? Make one conversion this year, then another. Gotcha. So just to explain kind of what Susan was talking about. So we're going to go back here in the partial conversion slide. So when you do conversions, and when I mentioned about doing backdoors constantly, you're right. You're not wrong. So there's a separate clock. We were talking about one clock. When you make contribution, it starts the life of the Roth IRA. We'll call that the clock of the life of the Roth IRA. There's a second one, the clock of conversions. So when I take money out of my Roth IRA account, it has to go back a little bit to basis. So we're getting a little bit on the basis and more of Roth IRA stuff, but it goes back to basis. Basis is what the IRS deems as money available to you inside your Roth IRA at any point in time, despite your age. And that's always going to start off with your contributions. Contributions, if I put money in today and next year I want to take it out, I'm in the clear. It's my money. IRS says, hey, that's after tax money. You can touch it all you want all day. And so that's the first portion of funds that you actually end up taking from the Roth IRA when you finally make distributions. It's from the amount that you've contributed over time. Now, the second piece that comes out is conversions. Now, what happens here is if I did a conversion, let's say 2021, then my conversion clock started there. The IRS, what they'll do is they're not going to tax you again. So let's say I took the amount I converted out personally in 2022. They're not going to tax me on that money again. I already paid taxes on it in 2021. But what they will do is they'll penalize me 10% for early withdrawal. For whatever reason, the IRS wants us to keep that money in there for at least 5 years. So theoretically, if I was doing conversions every single year, every little bit of piece of my Roth IRA has its own 5-year clock. That can be a little bit pain in the butt if you're planning to retire soon. If you don't plan to retire soon, it might not be too much of an issue to consider, because at the end of the day, from the moment that you reach 59 and a half, the clocks on your clock on the conversions actually don't matter anymore, right? Because the testing rule is not meeting the 5-year conversion rule and 59 and a half. It's the conversion will be tax-free to you if you meet the 5-year rule of the conversion or 59 and a half. So once you're over the age of 59 and a half, you're in the clear. The only thing you got to consider is have had the Roth IRA for 5 years at least. But if you're under 59 and a half, for example, me, and I want to take some money out of my Roth IRA, and it's only conversions, I have to make sure that I did that conversion 5 years ago. It's kind of a complicated situation. So if there's any questions on that, please let me know. But thank you for asking that question. There's a key thing there to definitely understand, and call us if it doesn't make any sense, but that's kind of how those conversions work and the timeline of those things. So again, the ultimate question I mentioned is just, is the Roth conversion worth it for me now? Right? It's a fairly straightforward process. It's moving one account to the other, but it just depends on everyone's personal situation and whether or not you should do it. Right? It does make sense in a lot of situations, and it does prove beneficial for a lot of individuals who are savvy investors and will grow that account exponentially. But for some, and for most actually Americans, it doesn't make sense. They don't do it for a certain reason, right? There's a reason of their life that they just cannot pay the taxes. So I understand both situations, but if you're here considering it, if you're learning about it for a reason, it might be worth putting the trigger on that and having the Roth IRA, at the very least, starting a Roth IRA. So I know someone earlier, kind of changing gears a little bit off topic. I have about 20 minutes for my hour, but may or may not go the full hour, but we'll see. Someone mentioned kind of legislation. So I wanted to touch on that because I know there's a lot of questions going on. For those not aware, there was a bill, did not pass, by the way, did not pass, but it was kind of caught and flagged, and it was quite interesting that it was very targeted towards IRAs and maybe potentially, how will IRAs be treated in the future? What can we do and what can we not do in the future? What are they trying to do? And it's ultimately, I can go on it forever, but I think it's a way for the government to try to access those funds a little earlier. So we'll go over kind of what that bill was entailing. Now, I don't think this is going to pass, but maybe some of the information here will pass. Who knows? So if anyone's familiar with Robert Thiel, he made a Roth IRA that was $2,000 into $5 billion with a B dollars. And so this really kind of put the government in widened their eyes a little bit and was like, we can't allow this, right? He has $5 billion tax free. So I believe that kind of also helped this bill kind of come to fruition. But again, has not passed. But I'm going to go over a little bit what it is. Correct name is Peter Thiel. Yeah, Peter Thiel. So the first thing on the bill that is kind of important for you guys to know is contributions over $10 million cannot be made, right? So they're targeting the ultra wealthy. They're saying if you have collectively more than $10 million in retirement accounts, not just one account, but multiple accounts collectively in retirement accounts, you cannot make contributions. All right. So they're targeting the ultra wealthy here. The second thing, RMDs will apply if you're someone in that case as well. They're just going to even though it's a Roth IRA, they're going to automatically just make sure that you take RMDs out. And the goal there is to lower you below 10 million. Once you're below the 10 million threshold, you no longer have the RMDs. But if you're over, you do. So again, they're targeting the ultra wealthy. You're trying to get taxes out of them and not have $5 billion Roth IRAs. They're completely eliminating the backdoor Roth IRA, or they want to, right? I'm not talking uncertainties. I'm talking that's what they want to do. Backdoor Roth IRAs will just not be available anymore. They want to eliminate the possibility of doing backdoor Roth conversions, not conversions in general, but just eliminating the fact that if you make over a certain income limit, you can no longer do that conversion. of specifically non-deductible contributions. I want to point that out. It's not, you can always do conversion, right? They'll allow you to do conversion all day because they're getting money. You're being taxed. But for non-deductible contributions, they don't want you to do conversion to those anymore. They won't allow it. It stays in the traditional IRA. So that they're limiting that whole situation right then and there. The second thing, or sorry, the fourth thing here, which I think is probably the worst one out of all of these, which will kind of hurt a lot of people here and a lot of people that work with Quest, et cetera, is they want to get away with people using their IRA funds to invest into syndications and accredited investment type deals, right? They don't want you to use that status to invest into these types of transactions, which is a huge chunk of people that invest here at Quest. They wanted to completely eliminate the ability to do that, all right? Kind of want you to go back to Wall Street, I guess. And then the last one is they want to eliminate you being able to invest into LLCs, trusts, AKA also known as checkbook control IRAs. For those of you that don't know what a checkbook control IRA is, a checkbook control IRA is when the sole owner of an entity like an LLC or trust is an IRA account, and they name the manager or the trustee in the trust case as the account holder. And the whole idea behind it is having that entity kind of manage the investments, do everything it needs to with the management of the account holder, but everything is for the benefit of the IRA account and it grows in there. Well, what they've done is they're trying to add that if an IRA owns more than 10% of an LLC or trust, it ceases to be an IRA. So they're completely eliminating checkbook control, right? Quest has kind of been conservative on the checkbook control. We've always said that, if you're going to have that situation, you should name someone else as the trustee or manager. But it is interesting. This would just kill it entirely because you will no longer have your IRA involved for more than 10%. So a non-deductible contribution is just money you put into a pre-tax account, like a traditional IRA, and you don't take a deduction on it. It's after-tax money in a traditional IRA. For individuals who make too much money, who can't do it directly to a Roth, as rule stands right now, you can put after-tax money into a traditional IRA and then convert it. With this bill, they are saying that if you put after-tax money in a traditional IRA, they don't want you converting it. They just won't allow it. Right. So this bill is kind of a shock to us. We had a little webinar about it yesterday. I think Sarah, if you don't mind, throw the YouTube the link again there. We had a webinar with our president, Quincy Long, asking him questions about it. And so it is a shock to us. We're combating it. And what can you guys do to kind of help also? Ultimately, just make some noise, right? Congressman and woman. I think every person here at Quest wrote the congressman and woman kind of a message saying that, we don't want this bill, we want to pass. And just let your voice be heard. If you don't know how, House Representatives, right here is the website. You can find a representative with their zip code. Very, very easy. Take me 5 minutes to do it. Ultimately, just disputing this whole thing, right? So I hope it's not going to pass. I really don't think it's going to pass, but it's kind of scary to think about the fact that they're thinking about this, right? They're thinking about ways to attack our retirements and primarily Roth IRAs first. Then it's going to be probably traditional IRAs, and then it's going to move into 401ks. So they're trying to, which I think is going to hurt a lot of us private investors. Sarah's going to post that link that's there. She's going to post a link if you guys want to help out there. You can just use that right there. Sarah's going to throw that in there in the chat box. So ultimately, kind of takeaways on this is get in while you can, right? Do self-direction while you can, because I don't know what's going to happen in the future. Especially Roth IRAs, since their eyes are on Roth IRAs right now. It doesn't mean you're going to do prohibited transactions. It doesn't mean you can't do investments right now. It just means that they're looking at it. So who knows what's going to happen to the Roth IRA in the future? Get one right now. Maybe it will be grandfathered in the future. We really don't have too much information on it right now, but get a Roth IRA before it's too late, because it is a huge advantage for you, for your children. You can do it at Quest, right? So take advantage of that right now. The last thing, or sorry, the second to last thing is what Quest has done right now is we understand that there's a lot of people out there that have personal situations. And so if you're in the Houston area, this might be very helpful for you. We're having an event this Saturday at our Houston office. It's just 2 hours, 11 to 1 p.m., and we provide lunch. And what we're going to do is, along with our president, Nathan Long, Quincy's our CEO, President Nathan Long, he's going to be giving a presentation. He's going to kind of go over what the IRAs from his perspective, what he's done with his IRA accounts. And then myself and a few others will be there as well. And what our goal is There's a lot of people that we've been getting questions on that need kind of more of a walkthrough of what they can do personally with the personal situation. And we want to walk through that with you, right? So we're giving 2 hours. We'll bring lunch, and there's 2 ways to join. You can do one, which is going to be online. If you can't make it, we understand. Or if you're not from Houston, we understand. Go online, join online. It's 2 hours of your time. Second, you can join in person. We would love to have you here in person, right? I think we get a lot more done in person. So if you can join in person, that'd be fantastic. Sarah's going to put the links as well to join in person and online here in the chat box for you guys if you are interested. All right. And then in the spirit of this horrendous bill almost coming to fruition and trying to be passed, we've created a Roth rush sale. So we want everyone to get a Roth in while they can. All you have to do is email me that you're interested in a Roth IRA, and myself or one person in my team will contact you ASAP to get that Roth IRA established. It's a very, very simple thing to do. You can scan that QR code, but if you want to kind of just discuss your situation prior, feel free to contact me at juan.deshon@questrust.com, or I'll see you guys Saturday. Again, just log on Saturday, or if you don't have the information or you want to get the link to join on Saturday, then email me as well. I can send you the link to do it online and to join in person as well, right? We're limiting to 50 spots. So email now, don't wait, because we don't want to fill the entire room right now. We're still kind of abiding by some COVID things. So we're limited to 50 people, but it will be lunch on us. We need a head count. So definitely register, email me for either a Roth IRA, Roth Rush sale, or to join us on Saturday. I thank you guys for your time. I hope it was informational. I hope it helped you. And if there's any other questions, feel free to reach out to myself and we'll definitely assist you. Thank you guys for your time.